Right, welcome back. We're taking more analysis now of that latest announcements by the Reserve Bank governor. The repo rate staying steady at 7%, which leaves the prime-rated banks at 10.5%. With me, Kevin Lings, chief economist at Stanlib, and still with me, Mamelo Matekina, macroeconomic analyst at FNB. All right, so during the break, you were talking about this issue with core inflation versus real inflation and why it can be an anomaly at times. Just take us through that.
So in the last inflation print, we saw core inflation drop, I think, to a year low, 5.2%. So essentially what that means is that inflationary pressures are starting to, underlying pressures anyway, are moderating. And it's quite interesting that the core inflation forecast for 2017 doesn't change significantly. So it either suggests that they think that this was a blip and core inflation should pick up. But if I'm right in terms of my forecast and that core number continues to dip lower, it does mean that the inflation environment, our underlying pressures are improving, and headline inflation should also follow suit in a couple of months.
Does that strengthen the case that indeed somewhere this year we could see an interest rate cut,
It does,
Kevin?
very much. Core inflation is actually critical. It excludes all the volatile categories like food and energy. I would agree with that forecast. I think core inflation remains well inside the target. Doesn't mean it goes below the midpoint of the target, but I think it's comfortable, and I think it does feed into an argument that there's not a build-up of underlying inflationary pressure in South Africa. We don't really have a wage stimulus problem going on. I don't think we've got the same cost pressures in terms of electricity, etc. So as long as core inflation stays at around the 5% level, which is entirely possible, the argument will build for an interest rate cut. As long as you get away from the volatility to the headline number.
Yeah, volatility again. I mean, I think he spoke more about political instability in this MPC statement than he did in the past few. How significant is that? Because, I mean, we saw the Reserve Bank governor going out of his way to say, we don't have political advisors at the Reserve Bank. We deal with economists. Fact of the matter is, it has a direct bearing on the rand, doesn't it?
Definitely. The environment has changed significantly, and you must remember that the sovereign ratings are also monitoring the country quite carefully. Moody's is coming out on the 7th with their assessment. This is not to say that they're going to downgrade the country immediately, but all of these things obviously are going to influence at how they look at the economy. So the macros are improving. Our GDP growth, but GDP is expected to pick up, and inflation is indeed moderating. So on that front, we're doing quite well. But on the politics, it's still very uncertain, and they will monitor that. And if we do get downgraded, granted that has been priced in, but if it is a little bit more aggressive, God forbid, this is going to have a huge negative impact on the rand and consequently inflation and so on.
It also tells you that if it weren't for these political events, we'd be having a completely different conversation today.
It was a question put to him, wasn't it?
I think that's right, because I think the conversation would have been, you know, when do we see the cut, not if we see the cut. And we would have been debating, does it happen at the next meeting or does it happen later in the year? That sort of thing would have been a key. He would have been much more bullish on where inflation's going. He would have highlighted that the growth rates look slightly better. I think the whole tone would have been different. The politics has overridden that. And it's difficult for him to make a bold decision while you've got that level of political uncertainty.
How significant, Mamelo, is his point that we may have seen that bottoming on the minus 0.3% growth rate in the fourth quarter of last year? I would think it's a given, especially when you look at the other positive indicators.
We definitely share the same sentiment. So we are expecting to see a cyclical rebound this year, supported by the agricultural sector and also mining on the back of this improvement that we're seeing in commodity prices. But again, this brings me back to a point that I said, noted earlier, 1.2, 1.1 or 1.3%, which is what the Treasury has for GDP growth, is still very weak. He himself highlights that GDP is well below potential, and I think at some point, you know, we need to really start having serious conversations about structural reform and how we grow the economy sustainably. He also highlights in the statement that, you know, we had this huge shortfall in revenue, and this of course is on the back of GDP numbers that were slightly lower than anticipated, which impacted revenue and other factors. And if we are wrong on this 1.1% and we see a GDP number that's lower, it means that the fiscus is going to come under more pressure as the months progress going into this year. So we are seeing a turn, definitely, but the long-term growth, well, the growth forecasts that they have up until 2019 are still quite poor relative to where we've been historically.
Kevin, it almost seems as though if we don't get some sort of an injection, you're unlikely to see any turn of events on growth rather than this very subdued line that we're witnessing now?
It's hard to imagine it. Obviously, the global backdrop, I would say, generally is supportive. Commodity prices right now are helping. The US growth doing slightly better. Europe actually doing slightly better. China doing quite well. All of that, I would say, is supportive. So from that perspective, we should see some uplift this year. But in terms of a real uplift, when we're talking about 3% growth, 4% growth, we're not going to get that without a pickup in confidence. And I don't think we're going to get a pickup in confidence without political stability. And it doesn't look like we're about to get political stability, which then translates into we continue on at these sorts of lackluster growth rates through all of this year until, I guess, we get to the ANC elective conference at the end of the year, and we get a better sense of where the leadership's going and what the leadership wants. And perhaps then there's a refocusing on how do we lift growth heading into the 2019 election. From a political perspective, that would make sense. Try and get the economy more robust before you go into the 2019 election. But between now and the end of the year, it's clear that there are a lot of political battles that are going to be fought. I don't think this is the only one around the Minister of Finance. I think there are many others in the background that will unfold. And so I think the political uncertainty will play out. What you hope is that we don't do so much damage to the structure of this economy while we're doing these political fights to, for instance, result in a credit rating downgrade, or to destroy confidence significantly, or to encourage more and more capital flight from this country. Those are the things we can't really afford. One understands that all emerging markets have these political wranglings. We're not unique in that sense. Brazil, Russia, Argentina, all of these countries go through similar events. Foreign investors know that. They appreciate that. They're not going to run away at the first sign of political trouble. It's a question of how much damage do you do to the structure of your economy while you're undertaking this political fight. And we worry at this point that you're going to start to do too much damage that is longer lasting, that impacts this economy over many years. So I think we've got to resolve this as quickly as possible and try get that confidence going.
And that's something we have control of. Something we have less control of is across the Atlantic, and the Reserve Bank governor alluding to it as well, or talking about it. That's the hikes in the United States, much more moderately than people had thought. Just give us your take on how much significance we should put on that. What's
quite interesting is that the Fed delivered their rate decision a couple of weeks ago, and we saw that the market had anticipated that the hiking cycle in the US is going to be gradual. And the dovish tone in that statement ultimately saw emerging market currencies actually performing quite better because we're still providing higher real yield. So the market has priced in a gradual interest rate hike in the US in a situation where that turns to being more aggressive, which at this particular point doesn't seem very likely because we're seeing this drop in real wages. But let's say in a situation where it does become aggressive, that's going to be rand negative. But as things stand, we offer quite attractive real rates, and that has supported the rand. It's just very unfortunate that the current political landscape has obviously overshadowed that.
And that's true, Kevin, isn't it? Our yield is an attractive yield, isn't it?
It's very attractive. A yield of over 8% on South African government bonds. If you look at the US government bond, you get a yield of just over 2%. So the difference is quite significant. And many foreign investors in Europe and the US look at South Africa and say, I'd rather get a return of 8% or 9%, as long as the currency is reasonably predictable and stable. So a lot of money was coming into South Africa on the back of that over the last couple of years, and rightfully so. But obviously this round of uncertainty makes those foreign investors question it, say, are we going to certainly see the same sort of yield because we worry about the Minister of Finance and whether the Treasury will be managed appropriately. And then we worry about what this means for the currency. So right now, foreign investors will be reassessing their portfolios. It doesn't mean they run away, but that reassessment can leave us a little bit more vulnerable.
All right, we're going to have to leave it there. Kevin Ling is Chief Economist at Stanlib, Mamelo Matikinga, macroeconomist or macroeconomic analyst at FNB. Thanks to both of you for coming in and sharing your views.
Pleasure.
And that's where we leave it. That's the special broadcasts from the Reserve Bank's Monetary Policy Committee. The repo rate staying steady at 7%. Your prime rate also staying steady at 10.5%. That's where we leave it. Bye for now.